The Monetary Policy Committee meetings were held over a 2-day period from August 19 to the 20th. And here we are now ready to hear the position that was taken by the committee. And without wasting much of your time, I will at this point in time call upon the governor to address the meeting. Governor, sir.
Let me just move on to the presentation. It's in 5 parts. The first is the decision that the committee made yesterday. That will be followed by a discussion, brief one for that matter, on the global economic developments with some insights on how those may affect Zambia. Then we will share with you domestic economic developments, which we think are relevant to the discussion of monetary policy. That will be followed by sharing with you the macroeconomic outlook over the next 8 quarters or so. And then we'll provide a conclusion. The conclusion really is more of a restatement of the monetary policy decision that was made. What it is that at our meeting, the committee decided to maintain the policy rate at 10.25%. It wasn't like in other settings an easy decision because, as you see from the presentation, that inflation has elevated and remains elevated. But there were other factors that we took into account which made us reach that final decision. In that process, what we looked at is that the projected inflation over the horizon, are we okay there? It seems there are people who they are not okay. Can we share the view? It looks like your colleagues are, can't you come down, the one with the camera there? Are you not able to capture from below here? What I was saying that the forecast of inflation over the period that we do the forecasting, which is 8 quarters, showed that inflation will remain outside our target range of 6 to 8%. But towards the end of that, it will come into the target range, although still on the upper side of that bound. So this, in a sense, underscores the point that the inflationary pressures which we have been highlighting in our previous meetings are persisting. This time around, I think you agree that there are even new factors which have come into play, in particular the issue of food prices following the drought that we had in parts of the country during the last rain season. So that is impacting adversely on prices of food, which have gone quite up. Then we also noted that growth in the near term has also weakened considerably, particularly when we look at the last MPC meeting. The situation has changed. Part of the factors there is the production of electricity. As you know, there is quite some load shedding which is going on. That is having an impact on the productive units. We also noted that there is some tightening of liquidity in the market. Last time, I think we were saying that there was quite a bit of liquidity in the market, but in the quarter that we are reviewing, liquidity has been quite tight. We see that these put together, they are posing a threat to the financial stability in the market. So when we put all these together, plus the fact that the economic activity is reduced, credit to the private sector is slowed down, made us come to the decision that we we did come. It must also be pointed out that we do have some changes at the Ministry of Finance. The new minister is still getting his bearings well, and his team are working on already the 2020 budget. So there are some aspects that we think will come on stream. So we felt that at this point we could hold the adjustment in the policy rates. But overall, if you put all these factors into account, really you would see that the case for adjusting the policy rate upwards was quite strong. But taking these matters into account, we felt that we needed to take a pause and see how events evolve in the immediate period ahead. Now, in the global market, what we see that growth there has also slowed down. There have been kind of sequential changes to the forecast. The latest one shows that actually global growth has come down quite noticeably. You see that even in the case of China, which is a major demander of our products, here the copper in particular, growth there has also slowed down. Now, advanced economies are the ones who are really leading the pack, in, so to speak, in terms of that growth slowdown. Now, there are many factors one can highlight here which have contributed to that slowdown in growth, some of which are the ones highlighted on the screen here. We see that there is a decline in investment and demand across advanced and emerging markets economies. So as you know, if demand slackens, investment also slackens, obviously that does not portend well for growth. We have also noticed that there is reduction in global trade occasioned by the trade tensions that are taking place. You see that there has been a postponement to December on some of the decisions which the US wanted to make regarding tariffs against the Chinese products. There have been retaliation in some cases also by other countries. So these tensions put together, they are not auguring well with the global growth and also global trade, as it were. So there is a threat, if you will, in terms of multilateralism. I think this is something which is being highlighted by other global leaders, that we seem to be moving away from a situation where there was coordinated activity, but now these trade tensions are threatening that. Europe, they are still also dealing with the Brexit issue that has its own uncertainties being thrown into the arena, that is creating some uncertainty on the economic agents. So that put to the ones who have highlighted make growth kind of precarious. The other thing we noted is that there is rising geopolitical tensions in some parts of the world, notably the Middle East. So those also don't augur well with the growth of the global economy. Now, with the global economy slowing down, this is where the importance for us is that how does it relate to us? You may say that's far off. Well, we live in an interdependent world. We export things to some of these countries. So if demand there is slackened, it means that demand for our commodities will also be adversely affected. Now, when we look at the commodity groups, we see that copper prices, which had risen in the, you see, if you trace back to the second quarter of 2018, they are reaching towards the $7,000 per ton. They came down. There was a slight pickup in the first quarter of this year, but in the second quarter, they have again come down. Again, link that to what I said about the global economy. Then oil prices, you may say for us maybe it's a plus that they haven't risen as much, but think of it this way. There are people who are producing that, who depend on that. So for them, it's not very good news that the oil prices are coming down. But who said the world is fair? The world doesn't always turn out fair. But the point is that oil prices have come down since the second quarter of 2018, which had gone up actually in the third quarter of 2018. Wheat prices have also come down. Maybe with these shortages that we are saying, they might start going up, but for now, we see that in the second quarter they had come down. Maize prices have risen. I think that's not counterintuitive. It should be quite expected, given what we have said and we have seen in our own country here. Cotton, the prices have come down also quite considerably if you look from where they were in 2018. Sugar has kind of remained flat at $0.3 per kilogram. Soya beans has also come down. So all that this is showing is that there is a knock-on effect on commodity prices by what is happening in the global growth, so to speak. Now, if we quickly now turn to the domestic economy, the inflation story, as I said, is the inflation has been rising. Now, if we look at this presentation in two parts, first we look at the quarter-on-quarter movements. What you see that annual inflation in the second quarter has gone up to 8.1% from 7.7%. Now, the major driver for that, obviously, is food, which has moved from 8.0% to 8.9%. Non-food somewhat remained constant, reducing marginally to 7.3% from 7.4%. Now, if you look now month-on-month movement, but these are yearly month figures that we look at March, you can see the trend also there coming through. It was 7.5 March, went to 8.6. The latest figure that we have for July is 8.8%. Next week, I believe, we should be getting the August figure. So this is consistent with what I was saying, where inflation is and the forecast that we made. Again, there you see that is consistently food prices which are pushing. Of course, non-food had a major push in the June figure, but since then I think it has slowed down, but food continues to be quite a major driver of what we are seeing in the food. So the chart on the right is really a graphical representation of this table. Now, what are the major factors behind this? What we see that the rising food prices, the pass-through from the depreciation of the Kwacha. I think last time when we met in May, it's a time when I think there was a major adjustment in the Kwacha value. It had depreciated quite considerably between April 1st and May 17. We saw a depreciation of nearly 15%. But as you see later, actually the Kwacha kind of recovered some of that lost ground by the time the quarter ended. This now looks at how do we deal with the liquidity issues in the economy, vis-a-vis the policy rate. Because when we announce the policy rate, there are certain expectations that we have. One of the major one is its relationship to the interbank rate, the average interbank rate, because that's the one, as you recall from previous conversations, we are targeting that the interbank rate should in time become the reference rate for all the rates in the market. So we therefore now have to deploy our tools to ensure that that rate remains within this corridor. The corridor, this is the brown shaded part, which is the 0.9, sorry. It's, we take 1 percentage point above and 1 percentage point below. So that's the path. So the red is the policy rate, the green is the interbank rate. So the idea is that it should stay as close as possible to this, but at any rate, it shouldn't go beyond that point or below that point. The green should, as much as possible, stay to this, but it shouldn't go outside this corridor. Now, if it moves away from this, we have to do some open market operations, equally when it comes down. So what we are saying here that during the period we are looking at, it stayed within the corridor, but it was quite elevated because there were liquidity challenges in the market. There was tight liquidity. In the process, the bank had to undertake injections of liquidity into the system through open market operations. So having done that, what we are saying is that the rate ended the quarter at 10.05%, which is still within the corridor. So for our purposes, we say that monetary policy, open market operations were successful in ensuring that the interbank rate remained within that corridor. Now, this now shows the way really the liquidity influences were playing out. So what really drove what in terms of that liquidity. But what you see in this, now these gentlemen are helping out, but there is obstruction also. Okay, so what you note, well, as I said, is this bottom line. If you look at the closing balance in Q2, it was 2.2 billion kwacha, but Q1, the closing balance was 2.2 billion kwacha, which meant that there was a reasonable amount of liquidity in the system. But when you look at the Q2, you find that actually that dropped quite significantly to 0.9 billion kwacha. And what we are driving this, the net government spending withdrew 4.2 billion kwacha. Bank of Zambia foreign exchange influences. This is when we purchase foreign exchange, we obviously pump in kwacha into the system. So ordinarily, by doing that, that should have obviously augmented that liquidity, which would have obviated the need for us to undertake expansionary open market operations. But this time, because of the tight liquidity, we had to inject 1.5 billion kwacha into the system. But even with that, liquidity still came down to 0.9 billion kwacha. So this is what this is trying to show you, that there was tight liquidity in the system. Now, government securities, this is another market which has been under pressure for some time. That pressure hasn't gone away. If anything, it even intensified in the case of the bonds particularly. The Treasury bills were also adversely affected but not to the same extent as the bonds. As you see here, in the first quarter, the subscription rate was 91%. This came down to 79%. But when you look at the bonds, on the other hand, the decline was much more pronounced, declining by almost a half, from 29% to 15%. But even though this happened, there were still some surpluses in that the amount raised was still sufficient to cover the maturities that were occurring during that period. So small surplus was still made during the period, which obviously added to the stock of the government securities outstanding. So here is the detailed presentation of the government securities. The left panel shows you the auction activities. What we are showing is that if you look at the last bars here, it shows there is a small surplus here of 0.7 billion kwacha. The orange is the funds that were raised, and the blue is the maturing securities. So you can see that the funds raised were more than the funds that were raised. So the small surplus. That small surplus obviously translates into more outstanding government securities, which rose by 3.5% to close the quarter at 60.2 billion kwacha. So in terms of the composition, this is what the right panel is showing. We have the blue, these are the treasury bills, and the brown or the orange, it's the treasury, the bonds. So you can see that the bonds increased. There was a slight increase in the treasury bills as well. Now, the other story we tell about this is that who is holding this? So we try to divide this in terms of the residents and non-residents. So the non-residents were still there, but they were out of the bonds, the treasury bills. They were concentrated in bonds. So what maybe let me go back here. No, we don't have that chart. I want to. So, let's see. Okay. I think the point I wanted to make is that the non-resident holdings of government paper has come down to, I think, to something like 13.6 or so percent. It used to be as high as 18% previously. Now, because of the demand that is rising and the issue of tight liquidity, we see that the yields on these instruments went up. So you see this snake-like movement here. You recall at some point when I was saying that we have some challenge here in that the blue, that's the treasury bills yield rate, and the orange, that's the bond yield rate. Ordinarily, the orange should be above the blue, for the simple reason that the time value of money, when you put money for a longer period, you should get a better return than when you put it for a shorter period. So earlier on, we had seen that the treasury bills were actually fetching more, which was quite well. Now, this corrected, but perhaps it overcorrected here, that you see the yield rate on bonds jumped from 27.7 in the immediate past to 29.6, almost 30%. So if you invest in there, this is what you'll be looking at. So when you look at the policy rate, you look at the inflation rate, that's a good return. But there are other implications on other variables. So the Treasury bills, on the other hand, you see that they rose moderately from 22.6 to 24.3. So they are all going up, reflecting liquidity conditions and the desire for government to raise funding for its operations. Now, these obviously feed into the other interest rates. Remember, our aim is to try and to get the policy rate to be the one which does the magic of being the anchor. But in the immediate period that we have, there are these other channels where pressure is brought on interest rates. So when you see the yields on government securities going that high up, obviously they will have knock-on effects on other interest rates in the market. So here what we are showing, if you look the red, this is the one we have been, maybe I've been getting sick of it, but we look at it on a daily basis. This is the average lending rate. Then this, this is the overnight lending facility rate. When banks are stressed for liquidity, they will come to the bank here, ask for assistance, but they also have access to their statutory reserve ratio in the day. But if at the end of the day they are not able to square, then they get a loan which you call the overnight lending facility, and that's what the rate here is showing. But this is linked to the policy rate, if you recall our previous conversations. Then we have the interbank rate. Again, you see here the green one. This blue is the policy rate which we have given. So what we are showing here is, look at where the interbank rate, look at what the OLF is, look at what this is. So if we superimposed on this the yield rates on government securities, you see that they are hovering above there. So that's what is pulling these rates to a large extent up. Then we see now, look at the credit, because as I said, part of our story is to really understand, is there credit going on in the economy? More so credit to the private sector, because that's where we think more sustainable growth will come from. Government may be a good borrower, but it may not be a good investor in terms of sustainable growth. It gives this initial pressure which the private sector must pick. So when we look at this, we see that there was general growth in credit to the domestic market. But when we look at the composition of that, what we observe is that the credit, though increasing generally, the year-on-year growth in credit to the private sector slowed down from down to 21.4% from 22.5%. You may say that, well, these are minor movements, but the direction matters also, because then that momentum needs to be built up. So this chart is trying to show you the different parts. The purple, that's the gross claims on government, that's the obligations of government. Then we have the public enterprises. If you superimpose the two, that's why you see that it's quite significant going to the public sector. Then households, very small, the green one. Then private enterprises. You see how it had even gone, so it had come up there, down, it came down, down. This is the slowdown we're talking about here. So we would like to see more activity in the private sector to be consistent with the notion that the private sector is the engine of growth. But from this, we don't see that happening yet. Here we see money supply. Now, money supply is related to economic activity. If there is no much economic activity, you need a lot more money supply to support that. but also money supply can be used too. I think that's why we moderate that to see that there's not too much or is too little. There should be sufficient to support economic activity. But what we see in this case is that actually there was a slowdown in the growth of money supply as well. You see it moved from 17.6% to 15.4%. So this is this chart, the year-on-year growth. So that is not sitting well in terms of supporting economic activity in the economy. Now, we look at the exchange market, the foreign exchange market. Remember, I said two major drivers of inflation which we have observed in recent past is food prices and the pass-through from the depreciation of the exchange rate. So what we see here is that the exchange rate during the quarter under review depreciated. But you recall, as I indicated earlier, in May when we are meeting here, the exchange rate has just gone through a major depreciation, depreciating, as I said, by almost 15% between 1st April and the 17th of May. So, but by the end of the quarter, the exchange rate had recovered some of the lost ground. So if you look at, these are the different pairs here. The red is the US dollar Kwacha. You can see there it's slight movement, but you can see the big movements which happened in May, starting from April. Then the British pounds, so all showing some depreciation. Then the euro and the Zambian Kwacha is that one. Then the rand and the Kwacha and that. So what we are showing here in the table, that in all these cases, there was some depreciation. The biggest depreciation having been between the Kwacha and the dollar. So it depreciated by 7.7% during this period. But that is a recovery from the area depreciation of 15%. Against the pound, 6.2, against the euro, 6.5, and against the rand, 4.8. The rand was also having its own challenges with the dollar. So this is what explains. Now, why this came about, why this depreciation. Some of the key drivers were the imports of petroleum products, strong dollar, as you see in the US economy, quite apart from the fact that the global economy has been slowing down, the US economy had grown markedly. There in growth of 2%, I think is huge for a big economy. If you see what I mean, if you look at the economy of the size of 15+ trillion dollars, if it grows even by 0.01%, that's a big movement. Think of a ball. If you are rolling a ball, a bigger ball, a small ball. If a small ball is rolling, you see it fast. But a bigger thing, when it is rolling, you may not see it, but it's moving. So that's how perhaps you can characterize that. Then the negative market sentiments arising from the credit rating downgrades. I think we had a number of those coming through during the quarter, and that had an effect on the exchange rate. Now, in terms of the supply of foreign exchange in the market, again, we see that the mining sector continues to be the major single kind of sector which is contributing to the supply of foreign exchange that we have. Then on the usage side, it's the public administration, which is debt service essentially, and other operations. So these others are all users, wholesale, retail. I think you see all these wholesale shops. They don't bring foreign exchange, but they use foreign exchange. So that's one of the things. Maybe among us, some of us are involved in that. So this is where we fit in. We should be on this side by producing. You see, even in households, at least they supply something, which is individuals seated here, maybe you exchange some money. Construction also contributes to something. Agriculture and forestry, very small, but at least it did, but it also reflects what is going on in the sector. Otherwise, it should be foreign financials. These are foreign financial institutions who principally take part in our government securities market, so they bring in some foreign exchange. Now, what we are saying is that in the quarter under review, supply was more than the previous quarter. So we had the net supply rose to $237.1 million from 212.4. So we should see some stability, and that explains why you didn't see that much pronounced depreciation of the exchange rate. In the quarter also under review, the bank did buy on a net basis $140 million, and we did receive, that would be something else, the minor royalties, but this was quite an improvement from the previous quarter. And the importance of this also you see in the statement that we have issued is that it has moderated the drawdown in reserves, which remain fairly at the same level that they were in March. So June and the March figures are very much the same, slight increase in June, but pretty much the same, and the month of import cover remains at 1.7 months. This is more information on the external sector, principally talking about the current account. This is a very interesting development, and one which also outsiders look at a lot. How do we fare vis-a-vis the outside world? So this is the balance of payments. So what we see is that the current account deficit narrowed to $268 million from $246 million. Here, actually, I thought maybe we could also show you in terms of percent of GDP, because that's the one which you can easily make comparisons with the other countries. But you can very well see that if you look at GDP, and this definitely is not so big a gap, because when you have a deficit in the balance of in current account, it has implications on the exchange rate and the other activities in the economy. So how did this come about? It's explained through this table, where we see at the top, those are the figures I was quoting, 246, 168, but they are derived from below, the way it happens. So total exports were close to 2 billion, let's say, of dollars, but imports, on the other hand, were 1.7. So you can see that that's why we have this trade surplus here, there. But if you look at that line alone, you see that there was a constriction here. That's why you get this negative outcome in the current account there. But also significant here, of significance is the NTEs. These are the non-traditional exports. There was a pickup during this period to $577.6 million from 489. But we believe we still can do a lot better in that area. I'm sure many of us here can become contributors to that if we really became entrepreneurs. So the overall balance, obviously, is one which you are showing here is a smaller deficit. So the outside world looks at this very closely. Now, the only challenge we have is that there are a number of revisions that happen. So sometimes we may not be able to show you consistently, but we try to get this information as accurately as we can. I think part of the challenge is getting information on some of these areas. The primary, secondary income, the capital account, it's not easy. Some of the people are borrowed, they don't want to share information. So it's a challenge which we are working on continuously. Then the real sector, this is another area which we find was troubling in the quarter under review. What we see that the estimates, preliminary estimates from the Central Statistical Office indicate a slowdown in real GDP growth to 2.6% in quarter one of 2019 compared to 2.7, which was achieved the previous year, the corresponding quarter. So this is really not where we want to be. And also, if you look at what the population growth rate is, that's not where you want to be. Now, when we look at other indicators of economic activity, they are also showing a story of reduced economic growth. So that's what we are saying, that the near-term prospects were weak during this period. Now, liquidity challenges and constrained aggregate demand were the major factors behind what we are seeing here. Then inflation, I think I gave already some talk on this, but just to recap, we are saying that remain above the upper bound, but key upside risks must stress here that when we do the focus to inflation, we do look at what would happen in the period ahead, what could go wrong. So what are the risks in short that could make inflation go up, and what are those beneficial risks which could happen to bring inflation down. So when we weighed the two together in this period, we find that the upside risks were more dominant, meaning that inflation has the potential or has a bias to go up. Why is that? Well, one of them is this persistent drought conditions, which may result in reduced domestic and regional agricultural production, which we are already observing in the market. Unfortunately, also here we are very dependent on hydropower generation. So the low waters is affecting us through lower electricity generation, which has its own adverse implications as it raises the cost of production, and even the time that the agents can operate is reduced or conditioned by the amount of electricity or the time of availability of electricity. Then the other issue which has continued to be challenging is the higher than programmed fiscal deficits. I'm sure you have seen the other documents which are in the public domain. The minister has spoken to this. The IMF has spoken about this. It continues to be a challenge, and we need to address it, and address it very, very quickly. The other problem we see in the horizon is this elevated debt service payments. I think for the year to June, we had paid close to $600 million. I think that information is also in the public domain. So this is a much faster rate that we had. So if we didn't purchase that foreign exchange that I talked about, we could have seen even a lower drawdown, more drawdown on reserves. The other risk we see is weaker than projected global growth, which we already mentioned. So when we look at this, what can really moderate this? We don't see many in that category, but there are some positives, one of which is that subdued domestic demand. Okay, you may be saying, no, this is bad, but it works well for the inflation because the demand is not as huge as it should be. But that has its own implications. But for inflation, that's what we are seeing. Then the relatively loose global financial conditions. You have seen some of the big central banks have relaxed their monetary policy stances to try and give impetus to growth in their own economies. I often say that, yes, it's happening there. What about us here? I think that's what we should also be looking at more closely. Real GDP growth this is the near-term prospect that we are talking about, projected to decline to 2% in 2019 from 3.7% in 2018. That's quite a dip, and it has implications. Then this slowdown reflects a contraction in agriculture production and constrained electricity generation. The lower than anticipated mining output due to operational challenges some major mines is also projected to weigh this down. So this is a picture on growth which is concerning, and a lot of effort has to go into turning this around. And part of our reasoning is not to adjust the policy rate up, is to try and help this situation out. Conclusion, I just come back again to where I started from, saying that the Monetary Policy Committee observed that there were elevated pressures in the second quarter, and when we projected or forecast inflation going forward, we see that it will stay outside the target range for much of that period. But when these issues of shortages of food and the thing are corrected, which is being done, then we should see inflation coming down to the range. And that's why we said, no, let's see how this happens. Then the upside risks are judged to be dominant to the inflation outlook. And if they materialize, we expect higher inflation outcomes. And in that context, as a committee, we stand ready to make adjustments to the policy rate appropriately. The committee also noted that since the last MPC meeting, the further weakening of near-term growth prospects, liquidity challenges, risks to financial stability emerged. We also stress that for us to really not rely so much on monetary policy to make the adjustment, we need to move on addressing the fiscal deficit, addressing the elevated debt and debt service levels, addressing the high domestic arrears and the liquidity challenges that are confronting our economy right now. So what we say, and as always, we are all in it together, but each one of us must play their part. So our part we have played is to stay the policy rate where it is, while we expect other agents to take on their role. Thank you very much.
At this point in time, I will invite questions from the media if there are any. As always, please state your name and the media house you are representing.
Good morning. Gladys here from Zambian Business Times newspaper. I have two questions. First one is, Zambia is reported to be spending more on debt servicing in dollars due to Kwacha depreciation. So I wanted to find out from BOZ what are innovative methods that you've put in place to get back Kwacha to its previous range of 9 Kwacha to $1. And the second one is liquidity in the market for ordinary citizens and local businesses is getting tight, just like you mentioned in your presentation. A lot of businesses are complaining that there's little or no business. So what are you doing as the bank to work with government to ensure that you pay local suppliers?
Good afternoon, Governor. My name is Jeff Kapembwa. I write for the Southern Times and Global Metals. Governor, I just wanted to draw you back to the credit to the private sector. I noticed there was a slight growth from up to 22.5 from 21.4%. My impression is that access to finance still remains a challenge to private sector. And government is talking about private sector-led economic growth. I don't know if we are working in tandem with what we aspire to do, or it's a contradiction to the aspirations of diversification, where the private sector must bring in cash, especially the local business community. I just wanted to also draw you back to the mineral royalty that you picked up from the foreign exchange market, $140 million from 103 over the ended quarter. I don't know if this slight generation could be attributed to the fiscal policy in place, which has drawn the government and the mining sector daggers heads. Could you comment on this fiscal policy and whether it has an effect on revenue generation from the mines? Thank you.
Good morning, Governor. My name is Munyumba Mutwali. I'm from Money FM. There has been a debate around the world regarding the transmission mechanism and its validity, especially to do with reining in inflation and interest rates, especially with what's been going on around the world. How has that affected any of the decisions? And is it something that's being considered, especially given that we do need to generate growth? And if we're keeping our rates higher, maybe we should actually consider looking at the global debate of actually easing as well, given that there have been questions coming in about the validity of the Phillips curve model and also the transmission mechanism.
Thank you very much for those questions. As I said, I have a very powerful team here. My colleagues, the deputy governors are here. The two directors are also here, but there are other colleagues, directors and assistant directors and other senior staff of the bank. So I may ask for help with some of them. Now, the first question which was raised by Gladys on the fact that the debt service is rising so much, so what are we doing to try and help get the Kwacha to regain its past levels? And I think you mentioned the issue of bringing it 9 Kwacha or somewhere there per dollar. First, I think as an institution, as a matter of policy, we don't target any rate. But I think the exchange rate, like any other price, is determined by the interplay of supply and demand. I think what we are trying to show you here is where is the supply coming from and where is the demand coming from. Clearly what you see here are challenges in terms of raising the supply that we want on a continuous, sustainable basis. I think that's connected to the issue which Jeff raised of diversification of the economy. That's where that argument comes from, that we need to really diversify our sources of foreign exchange and even of our livelihoods. So we, in the current circumstances, just looking at that, I don't think that's a reasonable expectation to make, to say that when we do that, this will come. It may be the case if, obviously, there is sufficient liquidity into the market. But what we are doing as a central bank, we are also augmenting the efforts of government in the sense that as a government entity, we have been buying foreign exchange to augment the reserves. But the job of reducing the debt service lies squarely in the Ministry of Finance. They are the ones who are contracting the debt, who are also paying the debt service. We just facilitate that payment. So really, that's where those measures which the minister, the president announced come in terms of wanting to slow down the amount that we are paying out in debt service. So we hear what you are saying, but you also point out that various players, including ourselves, we are doing our part, but there is a bigger issue that needs really more concerted efforts. Don't know if I have answered your question, but if you are not satisfied, please you can come back and maybe we can even take it offline. Now, liquidity tightness or the tight liquidity in the economy is for sure, yeah, you just recognized, like we do, that this is a challenge. So the government is, as we understand, they are taking measures to try and clear this, but they are also accumulating. They are not standing still. There are more which is supplies. But to the extent that the economy is not growing, this is also putting other constraints. So you see, it's like you get into a catch-22, that you are not growing, then you get no resources coming, then you don't get more resources, then you want to. So it's a secular kind of argument. But the challenge is, the issue is, not really the challenge, the issue is we have to stop this at some point and really focus our efforts on getting the economy to grow, and grow in areas which will generate employment, because then the more people will be able to be employed and be able to earn a living, and then they can be able to sustain their livelihoods. So payment to local suppliers, I don't think we are well placed to say more concretely what is happening, but what we can say that we have seen some reduction in some of the areas which were pertaining to the financial sector. Some of them now, the pipeline has reduced, but the backlog is still quite substantial. So I would urge you that I think at the next briefing that the ministry has, raise that question, and I think you'll get a better answer than we are able to provide you here. Yes, Chip, do you want to say add anything?
No.
Okay. Jeff's issue, I think that's what we all would like to see, that the private sector is the engine of growth. That's where we started also the conversation in terms of credit, that yes, there is growth in domestic credit, but it's not in the area where we would want it to grow much, which is the private sector. Now, there are many other challenges that the private sector has, but the issue of access you have raised is still indeed remains a challenge, not just from the point of view of the high cost, but even being able to get the high credit. We notice that there is a challenge. So the issue is just compounded when you have the cost of that money even higher. So there is a lot of work that we need to do in that area as an institution, as a sector, as other players in the economy. So you may wish to note that for the bank, in the next strategic plan, which we'll share with you once it is completed, is our focus is really to increase financial inclusion, because we think that as more people get into the financial sector, they can, apart from improving their livelihood, they can also contribute to the funding of the banks. I'm sure you visited the banks during the just ended show in Lusaka. We visited those who were there. There were 9 banks which were exhibiting, and each one of them was trying to mobilize deposits so that they can raise money more cheaply, because if they do that, then they are able to pass on that benefit to their clients. But there are all these other challenges which we highlighted, which make the cost of money still remain quite high. So it's something we all don't like, but somehow others just talk about it, but we must try to do something. So part of the the action that we are talking, which I'm sorry, I should have also raised it in response to the question raised by Gladys, that our staying the policy rates where it is also meant not to make the situation worse in that context. Because if it is made worse, then it means that there will be more shortages, and then again you get into a bind. So the idea here is to give some space, but that by itself won't be enough. Other measures, structural, fiscal, will be necessary to ensure that we get the lending rates, the access to credit lower. Anything you want to add?
Yes, thank you, Governor. I think on the issue of private sector credit, perhaps just to make the point that we really also have to look at what are the factors which are stopping or which inhibit the financial sector to offer that credit. And so, if you look at, for example, commercial bank might say the risk-free rate or the ability for me to lend to government at a high rate is high, so why should I lend to a private sector? So that's important. And again, there we see the government has set out a plan to lower the deficit. And that's why, even in the governor's statement, that encouragement is there that that process needs to continue. There are also issues around the borrowers themselves. They're risky. Maybe if I have collateral pledge, that's difficult for me to be able to realize if they default. And so there's a lot of other developmental things which we're trying to push in relation to other agencies. So issues around the collateral registry, issues around better information for customers about their loan term conditions, greater transparency, which the banks are showing in terms of what those terms are, and making sure that consumer protection issues are dealt with. I think we are in the process of trying to revise the Bank of Zambia Act, and issues around consumer protection are things which are coming out much more strongly in the proposed revised act. So I think the basic point is there are a lot of these other developmental issues which are maybe a bit below the surface. So even things around the credit guarantee, this collateral registry, not the collateral registry, this
Central deposit
credit reference, the credit reference bureau. These are important tools which in other markets, when they work well, help banks to be able to determine the riskiness of individuals who they're lending to, and therefore to be able to lend in a better way. So there are a lot of developmental issues which are also being undertaken, which maybe don't get as much limelight, but they're also very, very important in enabling the financial sector to really do its job, which is to be able to mobilize savings and lend money to those people who have the ideas and the drive to grow.
Okay, thank you very much. The first on the mineral royalty, just some more correction in terms of the figures. The 140 we are talking about there, and the 103, I think it was, is really these are purchases by the Bank of Zambia. The mineral royalty figures, you see them in the statement. What they were is in the quarter, it was $93.5 million. For the year to June, for the first 6 months of the year, mineral royalties were at $172.6 million. The purchases were $243 million. So the figures I shared in the presentation, they are relating to the purchases by the Bank of Zambia. But your main issue, really, I guess you are trying to get to us comment whether the discussions between the mines and the government have any effect on the revenues that are collected. I don't think we have a concrete figure to attribute to that, but what we see that the production of not really arising, what we have said in our statement is that there are challenges in terms of production in the mines. Production has come down. What contributes to that is many things. Of course, there could be some those who are saying, no, we wait for the conversation to be wound. So I think the minister and the colleagues are looking into that to see how that, I think you have had statements which have been made by government that whatever is done is not meant to jeopardize the operations of the mines. So what is being sought after is to get a fair share from what is happening. But obviously, when you have discussions going on, people have different views, but the objective is really to try and see how you can get a fair return from what you have in your, as your major endowment. So that said, I think the effects come from different angles. The copper prices, for example, are coming down. That will have a bearing on how the mines respond. There is the issue of power generation. That's also another factor which has to be taken into account. So there are quite a number of issues that have to be sorted out. But overall, what we see that there is a slowdown in terms of what we are getting from the mining sector. I think you saw in the slide that we showed the supply of foreign exchange is not as high as you would want it to be. Copper prices have come down, informed by what is happening globally. So I hope that helps. Now, the question raised by Munyembo Mtwale, this transmission mechanism, you are saying what is happening out there, why wouldn't we also do something similar? I think you are talking of the issue of quantitative easing or relaxing money. I think it is important to look at this in its entirety. I think we tend to look at just one aspect of it. If you look at the US, for example, the US Federal Reserve, what they look at is the target that they have for inflation. And you see that they are not there, the interest rates are not where their target. Inflation is not, is well below their target range. The same if you look at the ECB, that's what they do. So to do quantitative easing, you have to look at the material conditions in your own circumstance. You don't just do it because others are doing. I think we have been saying it here, and I'll say it again here, that the decisions we take are based on the information that we have, the evidence we have, and what the actors are doing in the economy. Now, look, I just mentioned that inflation is rising, right? Now, in that circumstance, if you did quantitative easing, you can imagine what would end up being the case. You'll be the first again who come and say, what are you doing, you people? Things have become more unbearable. So it put things into context. All these countries which are doing that quantitative easing is because they are well within their target range. Our target range here is 6 to 8%. Inflation is at 8.8%. So even conventional thinking, or even non-conventional, maybe I should say that, would point to you that you are not in the same situation as that one who is doing to do that, because they are trying to pump up the economy. But when you have inflation rising, the deficit rising, debt service going up, all these things when you put together and you do that, the outcome, my dear, will be a much worsened suboptimal situation. So I think it's important to look at these things in its entirety rather than just picking one aspect of it and then you try to imitate, because then we'll end up into a bigger problem than we had. So that's what I can say on this. We have done, having said that, you have noticed in 2018, we did actually lower the policy rate for 4 consecutive quarters until the last time when we made the adjustment. This was because we were well within the target range for inflation. So it's not out of the question, in short, that we can also do that if the material conditions are in place. I hope that helps. No, is okay. You have a rejoinder. He wants to say more.
Sorry, thank you, Governor. I think maybe what I was actually trying to say was, even given the same governors that you had mentioned, who were actually questioned on, is there still a material link between inflation and interest rates? And that's the question that's being argued these days now, is there actually, or is inflation coming from different areas, and are we just using that interest rate and we may end up hampering growth instead of, while we're trying to target inflation? And I think what we're trying to ask is, in your deliberations and understanding that global debate, do you still see that link holding? As even, I think Federal Reserve Chair Powell had even stated that he's also failing to see the link these days between inflation and inflation and the interest rate. So that's where the question's coming from.
Okay, very well. Thank you for the clarification. We still do see the relationship in our setting. Firstly, I think this framework that we are using now is relatively young. I think we only started doing what we are doing in 2012. Now, obviously, everybody has their own views, but what we see is that the countries which have adopted inflation targeting have fared much better, even especially in the financial crisis and all that. Now, in our setting, we are still finding the transmission mechanism which is really strong. There are two channels that we see happening in our setting. There's the interest rate channel, and in fact three. There's the interest rate channel, there's the exchange rate channel, and then there's expectations. But the expectations play on both because it amplifies or moderates risk perception. So what we see here, that there is still scope for interest rates to be a driver for inflation. But right now there's a lot of noise also, like we said. If you have the free rate, as you are saying, which is the government securities, which is you just invest and go for a holiday, and just wait at the end of the period to get your money. If that is very high, it's no brainer that you see where people would want to put their money. But what does it do in terms of productive investment? So that's still a challenge that we have. So in short, for this to work well, these other channels have to dry out, and then you get that. In the US, I think we should not be rushed to make that comparison, because this is a mature economy. Adjustments there are there's nothing now, very little, I shouldn't say nothing, because you can always find something on the margin that you can go and do in the US, which is not been thought out. That's why they are going on to all these AI, artificial intelligence and all that. Things can be automated and all that. But here, you still have big scope to do things. That's why you find that even the margins we talk about here, if you say you are making 25%, say, for your operations, people will say you are not making good money. But go in that environment, if you make 2%, you are making a big business. So you go for volumes. But here, we still can go individual and the thing. So there is still scope, in our view, to get this mechanism work. But there are these other noises. The other aspect that we have to take into account is that financial inclusion is not at that level. 2015, financial inclusion in Zambia was just shy of 60%. And if you strip that, and look at informal versus formal, you find that the formal was less than 40%, about 38%. So you can see that there's still some challenges in terms of getting that impulses into the economy. So that's one of the reasons why we are talking of financial deepening, financial inclusion to be expanded. So we see now in the financial sector is mobile money, using the telecoms and all that. In other settings, they have moved further. Banking has changed. You are using these suppliers of goods and services. You can buy right there and you get credit. So it's different, I think, when you look at the US economy and our own economy. I think there are structural differences which we must take into account. But we would like to argue that there's still scope for interest rate and inflation targeting in our setting.
Another round of 3, if there are any.
Afternoon, Governor and the rest of the high table. Stuart Lisulo here from Newsdiggers newspapers based in Lusaka. Governor, I was just wondering from a monetary policy perspective whether you could answer the question of how well austerity measures have helped to positively impact the economy. And I ask this question in light of the 2 major pronouncements that have been received by the Ministry of Finance, firstly last year and secondly this year. So how well have these measures worked on helping to improve the economy, if at all? And secondly, on the issue of reduced money supply to about 15.4% in the second quarter, you put this down due to a decline in foreign currency deposits, but I was wondering what's actually driving that? Why are we seeing reduced foreign currency deposits, which is causing the reduced money supply in the economy? Thank you.
Good afternoon, Governor and everyone. Chota Prudence from the Business Weekly newspaper. Bank of Zambia, one of the key driver of the currency pressure is that Bank of Zambia has been going into the market for dollars. That is according to some economists, and I would like to know how true that is. And if that is true, how long are we going to expect this to happen? And what long term are we likely to see on the Kwacha, the long term effects? Then the other question is that Bank of Zambia, as we are doing the presentation, the IMF, the World Bank, everyone has forecast 2019. The presentation you made, even in the inflation, you're saying we are likely to see things to stabilize within a forecast period. I would like to find out what period are you focusing on? We want to know what is that period. Then maybe with your permission, away from the monetary policy, I would also like to find out, just a month ago, you declared some institution insolvent, that is the Zampost and Pan Africa. So I'm sure Bank of Zambia did some research and everything involving the workers who are there. So I would like to find out how many job losses are we likely to expect because of the exercise, if any. Thank you.
My name is Esnat Lungu from Money FM. So I have 2 questions for you. The first one, although they are related to government bonds. So I understand you've embarked on programs to encourage ordinary citizens to invest in government securities. But then looking at the amount, the income that an average Zambian earns, which I believe is about 5,000 or so, how realistic is that, also considering the entry requirement into the bond market? And then do you have any systems in place that you are to facilitate new entrants into the bond markets, especially the ordinary Zambians? And then my other question is regarding when you talk about tight liquidity in the market. So we have a lot of village banking groups who have a lot of Chilimba groups. And isn't there a way that you can incorporate these groups in order to, help with the liquidity situation in the country? Because I believe there's a lot of money that is going around in these groups. Thank you.
Governor, you may take those.
Okay, thank you very much. I think here I need help. Let me first, I think this one I can't pass it on. The question raised by Stuart on how have austerity measures positively affected the economy? I think the verdict is still out there, isn't it? I think if they were working well, we wouldn't have the kind of challenges that we are having. So I think there is an issue of effective implementation which has to be done, and I think that's why we keep coming to this. The minister also keeps coming to this. So effective implementation still remains an issue that we need. Because once we do that, I think there may be hardships, fine, but we will shorten this, the duration of that if we did that. Because it's like if you are sick and they give you an injection, you dread it, but soon the pain from the injection will disappear and you get well. So that's what we need to take, that bitter medicine, so that we can get well. So I think the short answer to your question is that they haven't, that's why we're still talking about them and want them to be fully implemented. Foreign money supply, we say that we are attributing the decline to that, to a decline in foreign currency deposits. Maybe here I'll get the up either from, you want to? Okay.
Yeah, the fall in foreign currency deposits, probably these are linked to the source of foreign exchange. If you look at the balance of payments table that was put up on the screen, you note that over time, the earnings from exports have come down, even from the traditional sources, including non-traditional exports. They've stabilized around $500 million per quarter. Copper exports were as high as 1.6 billion at some point. Now we're talking about 1.3 billion. So that could be one of the factors explaining the decline in foreign exchange deposits. You also, if you look back, there was again a chart which was put up on the other sources of foreign exchange. They could be coming from private sources, for instance, construction. We've just seen a bit of that come through. But we are not seeing much from other sectors come bringing foreign exchange. So essentially, it's the performance of the external sector, because this is where foreign exchange comes from.
Okay. Thank you very much, Jonathan. A short set of questions. Yes, we are not denying, and we have pointed out that we are purchasing foreign exchange, so you can tell your source is correct. Yes. So the reason is simple. You see, I say that you can either complain about something or do something about it. We have all been saying debt service is high, reserves are dwindling. So how will you augment your reserves? That's the basic question that has to be answered. So there are different ways. There will be people who want to sell. You can borrow, but we saw what borrowing is brought on us. You know, you can get aid. We are not getting any aid from anybody, but we have entities which earn foreign exchange in the economy. So it's logical that you can go to those and buy foreign exchange, and that's what we are doing. So we are augmenting our reserves, your reserves, through that channel. Is it neutral in terms of effect on the economy? Of course not. It has implications in that. I did point out in the slide on liquidity influences that one of the influences came from purchase of foreign exchange. I think it was 1.9 billion kwacha, which was injected through that channel. Now, if we didn't do that, your reserves would be much lower, and then you're also coming that now we are running out of reserves. What are we going to do? So it's a balancing out. There's a trade-off to anything that you take. So our assessment is that we are better off doing that rather than let our reserves run to zero, because we have external obligations that we have to meet when they fall due. Most of us are users of foreign exchange, but we don't generate it. Now, what is the meaning? The meaning is that there are more demanders of foreign exchange than suppliers. And when the exchange rate moves in the negative, meaning depreciation, the import lobby is very strong. People say, no, how can you let that? Don't you know that we are import dependent? I have said it again, and I say it. We shouldn't be proud of that label, of say that we are import dependent. Why should you continue to be import dependent? What is it that we can't produce which others are producing? So look at the non-traditional exports, which links to the issue Jonathan was responding to. 577 million. Surely, for the economy of our size, for the kind of natural endowments that we have, is that really sufficient? I don't think so. In other countries, it will be maybe 2 or 3 players who are producing that. But now all of them put together, or all of us let me put it that way, put together. So these are the trade-offs that we have to look at. We have what it takes to generate enough that we need for our own use and even to spare. But we are not directing our attention towards that in a consistent and strong way. So we end up with a situation where we have less foreign exchange than we need. So produce some of these things that we need. If you go in the supermarket now, count next time you go, maybe you haven't paid attention, check what items are produced locally and how many, and then look in your own basket what you have bought and look at, usually we are quick to say, no, this is local, is bad. It's not of high quality. How will it get high quality if you are not buying it? Because the producer is not getting the income. So we are quick to buy the foreign, and then they will get that and invest in research and development to get it to a higher quality. So these are some of the dynamics. Some of the places people say, no, I can see this, yes, I can, it's not of good quality, but I can make do with it. That will encourage the producer to do better. I think in Zambia now we have a number of products which are produced and the packaging has improved because you are buying. But if you don't buy, they won't have the resources to improve on. So those are some of the things, and you, the media, I think you have a big role to play in terms of encouraging people. So I don't know, I don't think the bank is so concerned about that we are buying foreigners. We have to buy to meet our obligations, because if we default, you will be the first people who come and say, now Zambia has defaulted. What were they doing? You know, they were just sitting, you know. So that's not part of our way of approaching these things. We look for practical solutions and go for them. So the long-term effect, obviously, our intention is not to remain perpetually depriving. We buy as and when there is a seller, and we negotiate and we pay for it. But we need to move in other areas. If we can reduce debt service, if we can earn more foreign exchange, you won't even notice this. It's being noticed now because the situation has tightened. We have been buying foreign exchange for as long as I've been at the Bank of Zambia. I find it, they were buying even before. But now it's being noticed. Why? Because the situation has tensed up. But don't worry, that's normal for every institution, central bank, everywhere to buy foreign exchange and sell when circumstances permit. I hope that answers your question. Oh, you asked it. No, it's not out of question the issue of FABs and the Zampost microfinance. Yes, we took possession of those institutions because they were failing. One of the way we look at this thing is that we want orderly entry and orderly exit. Now, these institutions were not meeting, similar to the story I've been telling, meeting their obligations as they fell due. So they were risking people's money. You put your money there, you want it to grow, or at the very least, when you want it to be there. But you go there, they'll tell you a story, no, come tomorrow, we have a technical problem. You go back, the following day you go, that technical problem is never resolved, but your only problem is growing. So that's the disorderly nature we are saying. You borrow from somebody, hoping that you go and get your money. You go there, the money is not there. So we said, no, that can't continue. You have to do something else. Now, unemployment. I think my colleague, where is Frida? She may shed more light on that. Yes, they are employees, but then also they are managers. You see, they are managers of that. Who made the institution go down? So where should the first complaint be placed? Is it the Bank of Zambia or the management which ran the institution down? So those are some of the things we miss, because these are deposit-taking institutions. If they are not meeting their obligation, that means they are using your money, So that is not the way they are set up to do. So, but maybe Frida can give more insights on that.
Thank you, Governor. I think just to concur with what you have said, yes, it's likely that there may be job losses, but at the moment we are not able to state specifically because we're going through the process of verifying the assets and liabilities at both institutions. So the law provides us with 90 days with possibilities of restructuring or shareholders pumping in capital, and after that we'll make a statement to the public as to what's going to happen to both these institutions. Thank you.
Okay, we hope it's as always, if you are not satisfied with your question or if we have muzzled you, please don't come offline, we can talk. Okay. The issue on the bonds.
Thank you, Governor. I think there was another issue on, was it on the forecast for inflation? I'm not sure. I think it was basically, we forecast over a period of 2 years, so it's 8 quarters. So when we talk about the forecast period, that's what we mean. We forecast inflation 2 years ahead. I hope that clarifies that question. I think Esnat's question on government securities, yes, it's true. We are trying to encourage investment in government securities. This is part of a broader program to try and encourage, develop the secondary market at the institutional level in terms of the ability of people to buy and sell these instruments on the secondary markets to each other, but also to try and encourage other individuals to invest in them. Obviously, the returns on these investments are a lot higher than perhaps what you can get from putting your money in a bank and so on. And so we think that that will help develop the market. In terms of the mechanisms through which we can do this, yes, there are challenges. We do recognize that. And you can look at these challenges as one, the issue of information. And so we're trying to go out there and let people understand what they can invest. But two, also, there's the question of the instruments through which people can invest. And here, of course, we are looking at how we can use new technologies to invest in these instruments. I think in other markets, we're seeing people using mobile technology now, being able to invest in smaller amounts. So these are all things which we're looking at in the context of our overall program of developing the financial sector and in pushing financial inclusion. So I think these things, you'll see them come out as we roll out these programs. But the big thing is to get people to understand what is available and try and encourage them to invest whatever little that they can.
Just an additional point I can make to what the DG has mentioned here, that you see, say a choice issue here. Where would you put? This is one avenue also you can put your money in. The expectation is that not everybody will obviously be able to do that, but it's important to know that there's this option that you have where you can put your money. And by the way, there is actually a lot of protection to this. In the early years when this started, when a bank, for example, or a financial institution went and this money was compromised, not anymore. That once you buy that security, it's secured. Even when these people, like the institutions which we have taken possession of, those who have paper through that mechanism is protected. You get your money when it matures. So there is that protection as well that you. And recently, there is also no withholding tax on that, which was to encourage people to do that. So think about it as one of the alternative investment vehicles you can use to put your money that you don't perhaps need so urgent. But in fact, there are a whole range. We have 90 days, 182, 273 days, and 364 days Treasury bills. So you can see the range is quite long, they're quite big. Then when you come to bonds, you have 2 years, 10 years, and 15 years. And for bonds, when you put there, every 6 months you earn what is called the coupon, that rate which we put up there. So that's something to think about. The last question was on the tight liquidity, and then what can be done to encourage village banking, perhaps to help ease this liquidity. I think colleague Frida appeared recently on one of the shows, I think it was Kwacha Good Morning, to talk about this. Because initial take was as if we are saying we are discouraging this, which was dispelled. I hope you got that very clearly. We are nowhere discouraging this. In fact, we encourage it. But in terms of them now coming into the formal sector, I think that's the process now. We have to work with them to see how, but it does not stop the banks, the bank institutions to approach them, for them to bank with them. But then again, you have to step back and say, how did this come about? Because the banks are there, the non-banks are there. So there must be something which these institutions are not providing, which these are providing. So those are some of the things we need to get to know and get the formal institutions to understand. Because if you have Wichilimba, there are also risks there. Some people, once they get their 10, they stop paying and disappear. So there are all those risks as well. But at least it's done among people who know each other, and you use peer pressure to get your money paid. But it's something we are encouraging, and we want to work with these savings groups as well. Even I'm sure among us here there are people who are doing chirimba. Even people who are in informal employment, they do this chirimba, but don't go for Kalova. That will kill you, you know. So I hope that helps. We encourage, and if you know any, we would be happy to engage them and see how, but we are encouraging the banks to approach them and see how they can make them part of their ecosystem.